Welcome everyone back to Lamb's Cryptoverse. Today's guest is Mike Fay, also known as Fay Bomb, and he's over at Blockchain Reaction. Maybe you could tell us a quick overview of what you do for blockchain. Blockchain Reaction, and since we're focusing more on crypto, maybe you could restate your crypto journey that you mentioned to us at the last conference. Maybe something short and quick.
Yeah, I can do my best. Kind of learned about Bitcoin. I think it was 2013 or 2014. It was a while ago. Kind of was like, okay, I'll try it out and see if I can figure out how to buy it because I like the story. It sounds really interesting, and couldn't find it. So I couldn't figure out how to do it. So I'm just like, all right, no, it's too difficult, not going to do it. And then in the 2017 run, I started to pay more attention to it. I had finally had acquaintances in my normal life who were talking about it. My background, a little bit of FOMO, but I was like, this doesn't make any sense still price wise, So I've always been a gold guy. I've been very sympathetic to like trying to find an inflation hedge, or not even necessarily inflation, but trying to find like a hedge against fiat. And so Bitcoin, the longer it survived, the more it became that in my mind. And then when you start looking at Bitcoin, you start thinking about technology, distributed ledger tech. Money is just one part of, fintech and what kind of innovations we have. But what else is there? Well, can distributed ledger tech do anything else? And I thought to myself, it probably can. And, when I saw how Ethereum was growing, I really kind of got into that, and just started thinking purely like from a fundamental investor mindset. When you block out all the noise and all the craziness, like where is their actual value to this, and can we try to find that while other people are distracted by monkey pictures and silly stuff.
Huh.
So that's
Ugly
where
apes, in my opinion.
I agree.
Crazy.
What's funny about it, I'll wrap up here in a second, but NFTs, they probably won't be called NFTs because I think people think NFTs are kind of a joke, but what an NFT actually represents, ownership on a blockchain, I don't think that's going anywhere. I actually think that will do really well as an idea, 10, 20 years down the line. So you get into crypto, you start looking at projects and trying to think about how does this work, down the line, and you start making bets and you hang on to those bets. You watch some of them tank, you watch some of them do really well. And if you have an aptitude for it, you think, okay, how can I help other people maybe see these things too? Because, it's great for me to put these ideas on, but if I can help other people think it through as well, that seems like to have an added benefit, not just for me, but for people who actually value my thoughts. So I started the service, the Seeking Alpha Marketplace service, and that's where I'm at now, just trying to help people make sense of these crazy times.
Just going back to service, I was always interested, as you probably noticed in your articles, the free ones that you put up on Seeking Alpha, because there's more thoughts to them. Because I noticed that when I was trying to learn about, during my own crypto journey, I was trying to learn about crypto. And I checked out hundreds and hundreds of creators, YouTube creators. I went on websites, and it's like 99%, just like the number of shit coins out there. Right. 99% of these creators, or these people that authors that write articles, they talk about technical analysis and nothing else.
Right.
And there's more to it, to the story. And that's why I like the work you do, because we have a similar way of thinking and framework. We disagree sometimes, but our framework is similar. Like, yes, we look at technicals, but I also look at sentiment. And I know you and I both look at fundamentals. You got to combine them all together. So let's get started on some of the global macro. Now, as you know, today's meeting with you, and I was hoping James Ford would come, and he's not here today, but we'll get him on another show. So I was hoping to talk about altcoins, and we are, but before we get there, we got to talk about the elephant in the room. And I think you know what I'm talking about. These are banks beginning with the letter S. And over in Europe, let's start just in Europe now, because that's the news of the day. We've got Swiss Credit, also known as Credit Suisse,
Mm-hmm.
and then Societe Generale.
Mm-hmm.
They won the news over the last 2 days. And despite that, Christine Lagarde just over at the ECB, she just raised rates by 50 basis points. So she wants to break things. But let's continue with banks, starting with the letter S. So
Yeah.
we've got Societe Generale, Swiss Credit. Then we've got Silvergate, the crypto bank, and then SVB/Silicon Valley Bank. And last but not least, Signature Bank, which is like 3,000 miles away from me. They're over in New York City, and they're more focused on real estate, commercial banks, commercial real estate loans. So we have a whole mix of different types of loans here, including what's going on with Silicon Valley Bank and VCs. So what's your take on that, on this whole potential Fed breaking things? Do you think it's a vase? Is the Fed breaking a vase on my shelf back there that's already about to fall down? Or is this something more systemic?
Okay. There's so much there. The vase is already broken. You just haven't started sweeping it up yet.
Okay.
These banks, I can't speak to the foreign banks. I don't know enough about them. What I've learned from, the ones domestically that have failed is a lot of them are having problems with, their duration, right? And their whole model of fractional reserve banking is that a depositor gives you cash, you take that deposit, and then you loan it to somebody else, and you charge a higher rate than what you give the depositor. That's the whole model. And so, we have maybe 3 banks now that are now gone domestically, but a lot of other banks in this country have the same fundamental problem, which is
Same
that
business model.
same
Yeah.
business model, and they're doing very similar things. They may not have the same duration risk when it comes to short-term versus long-term treasuries, and that goes to the risk management failings of, I think it was Silicon Valley Bank is the one that had way too many long-term treasuries as opposed to shorter duration
Yeah.
treasuries. But
Yes.
it's the same problem. They all have the same problem, and that's that if everyone asks for their money at the same time, you don't have it. And if you don't have it, you have to sell the collateral. And if the collateral has been hurt to the point that you're no longer, in the money, then you're selling at a loss and your bank is in jeopardy. And the problem with all these deposits going in, look at the commercial bank deposits that went in to commercial banks as right after March 2020, when everyone started getting stimmies and all this money was pumped into the system by the Treasury and by the Fed. All this money ended up on these balance sheets. You can see it. Look at the chart. It's hilarious. You have this enormous spike in year-to-date change in deposits, and then it collapsed, literally elevator up, elevator down. And now it's so bad that the year-over-year change is negative. Why is this happening? 2 reasons that I see. One, this is the one that everyone's talking about. When your deposit base isn't getting a yield on these deposits, they're seeking out yields elsewhere. They can get them in money markets. They can get them from treasuries directly. You can go to Treasury Direct and buy them yourself. You don't need a bank to do it for you. So you've got that. You also have that inflation on a year-over-year basis still is high. And a lot of people have had to dip into savings to get by. And that also hurts the deposits as well. So you have, even if it's not a bank run, it could just be a very honest migration from one form of risk to another. Or some of this capital might actually be being destroyed through just organic growth. And when I say organic, I'm being a little bit, cavalier with that. But the growth and the cost of things that the people in normal day-to-day life, not the finance wonks or the normal people, they're dealing with high price increases in their everyday stuff. And if their income isn't increasing at the same rate, the money has to come from somewhere. So it's either coming from credit card debt, which it is. And when that's done, then it's coming from the deposits. So if the deposits keep going down, you don't even need an actual like traditional bank run where people are afraid of the banks. It really could be as simple as I don't have any fucking money and I need to spend my savings to get by. And if that's the case, all these banks are toast, which is why you had, this joint meeting over the weekend between the FDIC, the Treasury, and the Fed say, okay, we understand the situation. We're going to backstop all of this bailout. We're going to bail out all of these awful underwater treasury positions that you have because you bought them when rates were nothing and now rates are 4% and you can't sell them without, taking it on the chin because so what are we going to do? We'll let you borrow against the collateral at par. Even though we know, and you know that we know that it's underwater, we're going to let you borrow at par against collateral. Like, guys, connect the dots. Like, things are bad. That's my fundamental macro view. What do you think?
I've got so many questions and points to talk about. First of all, I was very glad to see you said something that no one's saying. Everyone loves to play Monday night quarterback. They like to blame everyone. So everyone's blaming Silicon Valley's bank's management. And I think I agree. I'm not sure how much of that is management's fault. I think management, because the Federal Reserve a year ago said they were going to dramatically increase interest rates. So the management of Silicon Valley Bank, their asset liability teams, they should have bought some short-term treasuries to hedge or do some type of hedging, either by futures or whatever, to hedge in their interest rate risk. But here's the thing. I think that's only some of the blame. I bet you that's less than 50% of the cause. I think it's what you said. I think this is basically like what we saw with Roblox and Zoom. This is going from the COVID-19 trade to the reopening trade, meaning there was a huge increase in deposits, then a decline. And so you might ask me, or not you, but other people might ask me, so Dominic, then why did it just happen to Silicon Valley? Well, I can tell you why. It's because Silicon Valley is less diversified than everyone else. If you go back to 2008, there were all these adjustable rate, crappy loans, subprime loans that just went bust. Started with New Century, started with the little fish, and then got to the big fish. My point is, if you look at the typical portfolio, I'm not even saying commercial banks, regional banks. Commercial banks are very well diversified. If you look at regional banks, they've got a lot of these 30-year mortgages. So they're doing well and they're locked up. These loans are already locked up and a lot of their customers are doing well in that area. Maybe they're losing out on the yield curve. Basically, they're not doing too poorly. And then, like I said, they're very diversified. The problem with Silicon Valley Bank is that dealing with private equity, private credit, venture capital / portfolio companies of those venture capital funds, and maybe even some crypto. They're not talking about crypto, but I think there's some hidden crypto risk in there too, maybe from the VC funds. But the point is, if you see something uncommon, what I said, it's mostly tech. So you've got basically one industry and mostly private versus where I used to work. I worked at major banks that had commercial loans. That's very different than what we have here. And also Silicon Valley Bank is smaller, so maybe their asset liability team in terms of hedging is not as sophisticated of the banks where I worked at. We had all kinds of modeling and stress tests. They also had to deal with CFI requirements, that's systemically important financial institutions. When the bank reaches an asset size of $250 billion, they have special, it's called prudential regulations, where they need to have higher capital requirements. Well, guess what? Silicon Valley Bank, not only was it more concentrated in its portfolio, it was below that limit. It was around 200 to 215 billion in assets. So it was below that CFI, or systemically important limit. So that's why I think this occurred. I think the number one reason is that it was not systemic. It had to do with the reopening trade, and that it is somewhat systemic because of a few reasons. There's like there's the ability for consumers, even businesses, to use their mobile phones and take out money.
Right.
There's that, and there's also businesses thinking, you know what, maybe I should test my revolving credit lines. A lot of these companies where I used to work at, we used to do a stress test, and basically what we did is we try to see if there's a financial crisis, any type of crisis, how much of those unused revolvers would be drawn down. Well, guess what? There's that other risk that maybe these portfolio companies, these VC portfolio companies, maybe they're thinking, maybe I should draw down on these revolving credit facilities, which are like credit card facilities, if you want to think of it that way. Maybe you should draw down on them, even though I don't need the money. So sorry, I'm talking your ear off, but there's a lot to talk about.
It's interesting. Keep going.
Yeah, there's a lot going on there, but I promised you we would focus more on crypto. So you know what? Let's segue from this to crypto.
Sure.
Here's a difficult question for you because it's difficult for me. So you mentioned that this could be a contagion. Am I correct?
I believe so. Sure.
And you also mentioned that the Federal Reserve, it's not just the Fed, governmental authorities, and not just here, overseas too. We saw what happened with Credit Suisse. They're getting a $50 billion loan on investment from Swiss National Bank. So we're seeing liquidity infusions going into banks in terms of guarantees of deposits, right? So here's my question to you. Here's where it gets complicated. The infusions or in loans to these banks to save these banks, this is an increase in liquidity in the system. However, here's the problem. Here's what I'm thinking. I think these banks are scared. And what happens is they won't want to lend out as much. So that could actually tighten liquidity. So my question to you is this an increase in liquidity, what's going on with the banks, or a decrease in liquidity? And also we have the issue with the debt ceiling, which is increasing liquidity. So and then we have decrease in liquidity because the Federal Reserve, in my opinion, is going to raise rates next week by at least 25 basis points, even though there's a potential crisis. So what's that answer to you? Are we increasing or decreasing liquidity?
God, it's tough, isn't it? It's almost like, you've got like a boat, and the boat has a massive hole in it, right? Yeah. And on one hand, you've got all this liquidity coming in, and a guy with a bucket, like, just throwing the water, throw the liquidity out, but there's still liquidity coming in through the bottom. It's a tough question. I don't even know how to answer it, because like you said, they could raise rates, but then they're also giving, these institutions the ability to continue borrowing. It's the $1 million question. I mean, people like Stan Druckenmiller. This is one of the most decorated, he's not a military person. He's not military, but, this is one of the most appreciated, traders, analysts, whatever you want to call them.
He's got a lot of battle scars.
He's got a lot of battle scars, right? Yeah, he's decorated, and he doesn't even know what to make of this. Even someone like Stanley Druckenmiller is saying this is one of the most challenging macro environments I've ever seen. So I can't answer it. I don't know. All I can do is try to watch the tape, I guess, look at the fundamentals and try to make bets, Yep.
It's funny you say watching the tape. That's what I'm looking at. You can look at the Bloomberg Financial Conditions Index, something like that. And it's got to be global, by the way, because the Chinese are increasing liquidity. So that's a fact. But the Japanese may tighten liquidity. But going back to what you said, I think we need to look at the tape. If gold prices keep going up day after day after day, that means that liquidity is getting looser.
That's a good point.
Yeah, so well, you said it. I took it from you. You said watch the tape. That's what I'm watching.
Yeah.
So I know you recently wrote an article related to the debt ceiling, basically how there might be more liquidity. So can you talk about it? Was wait, I'm sorry, that wasn't you. That was James.
Yeah, that may have been James.
That was James. So let's.
Where is he? Why didn't he show up today?
I don't know where the guy. Let me check.
I want to talk to him too. I got a lot of questions for James.
Yeah. Well, next time. There's definitely going to be a next
Yeah.
time. So, I've got I should have told you, I've got three parts of this talk with you. We got the global macro, which we
Mhm.
just did, but then we've got what we touched upon, current events.
Yeah.
And then lastly, we've got altcoins and crypto markets. So I'm going to talk to you about current events because these are current events in crypto, and this
Mhm.
is where we want to go. And there's a lot of current events thanks to the conspiracy, or I believe it's true, in choke point 2.0, if you know what
I
that
I
is.
I totally buy it.
The
Totally buy it.
Operation Choke Point.
Absolutely. 100% agree. It's
And
happening.
Elon Musk says all conspiracies are true. I don't know. I think he's a little delusional, but even though I love the guy, but he's a little off his rocker sometimes.
Quite a few of the conspiracies over the last 3 years have been proven to be a little too on the mark.
Yeah, and even the crazy people like Alex Jones,
Hmm.
he seems to be getting them right. He was the one
Yeah.
that, by the way, I know we're going off, but I got to talk to you about Alex Jones. He's the one that was talking about bringing people, some hedge fund guys and politicians, to this remote island with these pretty young women. This is going way back when, and people thought he was crazy. Like,
Thought
what
he
are
was
you
nuts.
talking? He was right.
He was dead on.
So I've got a lot of current events, so I'm going to talk about them quickly. We could skip over them if you want to do that because there's so many. The first one is about the SEC, and it's not just the SEC. Let's just call it SEC for now. Going after staking services. Now, my question to you is, what's that? What's up with that? Are they going after staking because they're going after high yield leverage staking and maybe companies that are rehypothecating, meaning that they're commingling funds or whatever, or they're using collateral twice. So basically, my question to you: what's going on with staking? Is that going to continue? Like, is conservative staking, such as when I or you go to Coinbase and you
Hmm.
do that delegated staking at a low stake rate, maybe like
Right.
you're staking Ethereum for 4% or 5%. Is that going to continue, or is the SEC going to go after all staking?
It depends on, I think, how hard they get fought by the people within the industry, right? So like what they have, in my opinion, been doing over the course of the last couple of years is they have just been trying to set little precedents here and there. And they try to get people to admit that they're doing something in a way that gives the regulators an ability to you know come at other firms with the same guidelines. So I think that staking as a service, what does that mean? Like the Lido finances, the rocket pools. This was a trade that people looked at right after Kraken's model was shut down. Kraken was a little bit different because they offered a very specific yield, you know, with your assets, your crypto assets on deposit. Something like Coinbase, it doesn't work the same. It's a little bit different. You're at the mercy of what the protocol yield is, and then you get whatever is
Yes.
left after Coinbase takes their little chunk of it. Long story short, I don't really know if the things that Coinbase offers will be deemed a security or not. Um, I would say that my thinking is that the SEC will ultimately try to claim that they are, um, because that's just what the SEC does. I think, or any regulator for that matter, I think when you give an inch, then you start inevitably getting asked for more
Take a
inches.
mile.
Right. And so I think that it just really all comes down to how much of a fight is the industry going to put up? Because if you have a whole bunch of notable people, notable exchanges, notable protocols start to fold here, then the SEC's case strengthens. But I don't think that we're going to see that. I think that we're going to actually see quite a bit of pushback.
Okay, good. Yeah, I know that the crypto industry overall has a lot of lobbying power, and they're trying to push back. So let's see how that goes. And there's going to be an election coming up.
Hmm.
Let's see how
Yeah,
that goes. I think that's going to change the winds, the
I
atmosphere.
I wrote an article about this, not on Seeking Alpha, but on my Substack, that I think that Gary Gensler is is becoming he's becoming a voting catalyst, I look at, I really believe that. I'm an independent, right? Like politically independent, just always have been. Almost always split my ticket. I vote for the person, not the party. But if one party is going to be pro crypto and the other is not, that's really going to change what I do. So if Gary Gensler is going to be the anti-crypto guy, I'm going to need an administration that gets rid of him.
And it's very ironic because many of the supporters of crypto are extreme left. They're Democrats. They're very liberal.
I think it depends.
I think it depends. Yet I feel inclined to vote for the more conservative ones because of what you just said. They're more pro crypto, but I'm an independent like you, and I'm really what I call, I'm not Democrat or Republican. I'm practical.
Right.
And I think if you look at things from a common sense point of view, you tend to
you tend to be a lone wolf.
Yeah, you tend to vote for what's practical, what makes more sense. Like I'm pro-regulation.
Sure.
But I want a level playing field. That's why.
Right.
But I don't. And then you have other people like Elizabeth Warren just to attack and get some press.
Right.
And that scares me. So speaking of attacks, I got one more. I have a whole list of questions related to current events, but maybe I just ask one more. And this is about, and this ties up a lot of things. I'm putting 2 or 3 questions together. There's something, I don't know if you know Flow and Dapper Labs, but basically a judge is allowing a lawsuit of Dapper Labs to proceed. And he's saying because they cited emojis, believe it or not, a rocket emoji, a money bag emoji, and a stock chart emoji. He's saying that these emojis allude that this NFT is a security. So besides that, I'm going to combine another question. It looks like the SEC's Gary Gensler is saying that under the 4-part Howey test, whether or not something is a security, that almost all protocols, including Ethereum, are securities. So what's going on? Do you think we're moving towards everything being regulated as a security? That's how I feel. I think a lot of them are securities. I got to be honest with you.
Most of them are.
And it walks and quacks like a duck, meaning people invest in cryptos because they want to make money. So what's your view on that?
Okay, great line. Walks and quacks like a duck. It's probably a duck,
not talking,
right? Yeah. Talking, and he's decorated duck. Walks and quacks like a duck. The thing about that is that Gensler is trying to say that all birds are ducks, right? Not that everything that quacks is a duck, in my opinion. Because 4-part Howey test, right? That's the framework. Well, the SEC, are they not picking and choosing when they want to use that framework to distinguish or determine what security is? Because I don't think anybody could argue that a stable coin has an expectation of profit unless you're using the protocol that any stable coin utilizes as justification for the underlying asset being a security, right? But it's, so that gets into a whole other world of problems. The question, because then Bitcoin becomes a security too, and the SEC has said Bitcoin's not a security. Everything but Bitcoin is a security in their mind. Most of the stuff in this space probably is a security, right? I agree with you. A lot of things are not. The problem is some things start really centralized and then over time are not centralized. Bitcoin is a perfect example. By any measure, Bitcoin is almost any measure, Bitcoin is the most decentralized currency in the cryptocurrency space. So that's why it's not a security, right? Because of the decentralization, there isn't a single issuer. But when did that happen? Because how could anyone argue that at origin block or Genesis block, it would have been, right? Because it came from one place. So this is what the cryptocurrency industry has been begging for, is clarity. Decide what is the right metric to justify when something is decentralized and when it is not decentralized. And then after you've picked the metric, what's the threshold? Because then we can figure out which of these things actually are and which aren't. Why is the SEC not doing that? It's because the agency wants jurisdiction over all this.
Yes, the fighting.
So they're not going to give an answer. Anyone who says that they've been clear is full of shit. They have not been clear at all. They've been the exact opposite of clear.
Okay, we're running out of time. We only have 3 minutes. So I'm going to skip over. I have about 100 questions for you. I'm going to skip over all that and get right down to one altcoin, which I promised I would talk about. Since you're talking about centralization, I'm going to push back on you a little bit.
Okay.
I think that Polygon, which is considered one of your favorite altcoins,
Yep.
your top idea, as you said it, I think they're very centralized and there's a lot of control by the founding members of Polygon. So I'm a little worried about them and they're not too transparent. Tell me in a few minutes why you like Polygon so much, why it's your top coin. If not, tell me another coin that's a top coin.
Well, okay, so Polygon is one that could definitely be considered a security. I'll be honest, I'll put that right out there. Why do I like Polygon? I like Polygon because Polygon is onboarding internet users to crypto rails without them realizing it. Can they do that as just an Ethereum network or a layer, a side chain or a layer 2, whatever you want to call it? Can they do that without Ethereum? Maybe if they shifted to something else, to another EVM or whatever. But Polygon is my favorite for the year, not necessarily my favorite overall. I still think that not everyone, a lot of people really like Bitcoin. A lot of other people really like Ethereum. The very clear failing of both of them is that there's absolutely zero privacy on chain. And this is fine for institutions, establishments, governing bodies. The transparency there is actually great. At the user level, no privacy is terrible. And so you need to have protocols and even, dare I say, alternative blockchains that have privacy as something that's useful. People hate Zcash. I like Zcash. It's one of my bigger positions. I think it's great. Serves both purposes. You have the ability to be transparent, but you also have the ability to pool into a private pool so that your stuff is not immediately visible. Now, the problem that people have,
is there KYC with that? Know your customer?
So it depends on what your on-ramp is. If Coinbase is your on-ramp, like I bought my Zcash through Coinbase. So it's very easy to prove how much I've purchased. You just don't know when I've sold it.
Coinbase does a KYC. Yeah.
Correct. So if you're KYC'd through a typical exchange, they already know what you have. They just don't know where it all is after it's been in the, if you've made it private. So, and I know you're running out of time, so I'll make this quick, but we have to decide if we want a cashless society or not. If everything must be under custodial control. Because if we think that, okay, if you want Zcash or Monero or something else that honors privacy, it's purely because you're a criminal and you're a money launderer, that fails because we still have cash. And unless you're willing to give up cash, no dice. So closing thought, I like Zcash as well.
Well, thanks for having you. We're running out of time. And next time, we're going to talk about lots of altcoins, including Avalanche, Ethereum, Cardano, Solana, Polkadot, and Algorand. And thanks for joining us at Lamb's Cryptoverse. And I can't wait to talk to you again. And hopefully, James Ford will be on. Take care, everyone. Take care.